Good morning, Captain. How are you, sir? I guess good afternoon.
There we go.
I appreciate your flexibility today, sir.
Hey, busy. Life is interesting. We all have our definition of what is busy, but I find myself thinking that I'm busy. Other people may not be as busy, but who knows? It's all relative. That's
I
deep.
could, yeah. I mean, whoa, man, what a way to start this baby off. I love it, man.
Yes.
Yeah, yeah. We just Aladdin Dow just had a space with Token Bryce and Robert Lauco from Liquidity, and
Yes.
very interesting to get their perspectives on decentralization, um, capital efficiency, their new V2 protocol that they're going to be releasing, but kind of in parallel with our FX protocol, stablecoin protocol. So really good discussion and input from everybody.
Well, I don't keep up with all innovation. What I do, my specialty is structuring everything. What's the relationship between things, the relativity and the causality, the effects? Liquidity is meaningful in the interesting thing that I observe, not to start things off if you don't want to do that at the moment, but liquidity aligns with the Balancer Federation more so than the Curve Federation. But they also appreciate the Bunny, which doesn't necessarily have a federation yet, but it's growing. But I find that interesting considering how Frax very much aligns with the Curve Federation. So it's a very interesting grouping of actors, and that'll create very distinct markets. Very interesting.
Yeah, that's actually like a really good a point you make about federations, and we can kind of vamp here until everybody gets on, but it's interesting to see which protocols choose which federations they want to align with, and I'm always kind of curious about those motivations, what drives one to do another, and so forth. It's always very interesting.
Well, we'll end up seeing, obviously they're inspecting capital efficiency of their capex. So they deploy $1 and they're getting, $1.30, $1.50 bang for the buck worth of liquidity incentives. So my 2 cents is zooming out, 1 year time frames, 6 months plus. We'll see cyclicality. It's like the cyclicality we see between convex vote rentals versus base V curve vote rentals. We'll see that between Aura and Balance doesn't get as much vote rentals as Aura, so that's interesting. The way that cyclicality may play out, we see more, I guess, Aura accumulation rather than Balancer. So maybe that's a distinction with the Balancer Federation as compared to Curve. We have yet to see what plays out with Bunny in the mix strapped on to Uniswap. But my gut says over the multi-year time frames, we'll see cyclicality where the most capital efficiency is expressed, and all of these uh, downstream actors that are financing liquidity using the capital efficiency offered by these federations, we'll see them cycling from one to another, which will result in ultimately liquidity depth cycling from one market, AMM, to another, depending on where the best capital efficiency can be had.
Yeah, I mean, yeah, that's absolutely going to be fascinating to watch how it all plays out over the next year or so. Be interesting to see who goes where, and what survives, and like you said, how the cycles play out. So
Yeah,
I tell you what, we are 5 minutes into the space. I tell you what, let's shall we get started here, Captain?
always. Pleasure.
All right. Well, welcome everybody to the Aladdin Dow A Team. We are very excited today to have on our Twitter space the highest ranking member of the military we have ever had on, the captain himself, Captain Rational. Welcome, sir. We are delighted to have you.
Much a pleasure. Maybe the captain of rationality, or it's like a puzzle observer. Everything is a giant puzzle of causality. Where do pieces go? How do they relate to one another? And then that's the thing I like to observe.
Well, I think we're going to enjoy having you sort of decipher that for us today. Maybe we could start off here. If you could give us a little bit of an introduction, maybe a little bit of your background, how you got to crypto and DeFi.
Indeed. Long in a galaxy far, far away, a long time ago, I went to school for electrical engineering. So I still am quite a software engineer and Android developer by trade, by profession. So that keeps me busy. Never quit your day job. Always need to be productive. Obviously, that could change over time, but I still entertain that kind of activity very much. I enjoy it. So, years ago, there was interest in the crypto space for me that started with actually Dash, good old Dash. And this was Bitcoin at like 225, 250 days, and we didn't know what was going on back then, but that's the best way to express my earliest interest in this type of space. I had no comprehension to the degree that I have now, none of the narratives I have now, but that was the time frame and where I started taking interest. Fast forward maybe 3 years, give or take, I found myself in Orlando. I was working at Universal Studios at the time, and I lived in this one-bedroom apartment right across the street from SeaWorld. That was fun. But I had 13 GPUs, and I was mining Digibyte at the time, and I was playing around, learning, enjoying. Still didn't have any comprehension of what was to emerge, and pretty much starting in 2020. But that was probably best described as the 2016-2017 cycle. And obviously everything went asymmetric, but there was nothing to the market. There was no products to the market. There was no product services. There was no liquidity. There was no concept of a financial system. So we had significant asymmetric appreciation, and obviously the collapse that occurred in 18 and 19. But I definitely identify that period of time as very interesting, given the things that I did, the time it was in my life, and everything we've done contributes to where we are now. And if I didn't do those things, I wouldn't have made the choices I did in late 2019 and be positioned the way I was in 2020 to experience the things I did, which led to my current understanding of markets. So that was a quick, probably about 10 years worth of my history of how I got to where I am now.
That's really interesting. I appreciate you. I've got a good bit of echo here, but I appreciate you sharing that with us. I was kind of curious. We had a discussion last week on the A-Team about sort of backgrounds and how they influence your decisions to participate in DeFi. And myself, I am also a engineer by trade, a civil engineer. But I'm just curious, like, do you feel that engineering background, like, do you think it's as beneficial to you as if you had had a traditional financial background, or was it a setback, or did you find? I'm curious how that it's influenced your decision making.
So my career never went down the path of engineering, but my engineering knowledge, or the things I was exposed to during institutional education, I always found the causal relation, or not even the causal, but just the analogy and the simile. And nowadays, I like to say that everything reduces to, biological processes or physical phenomena. And not necessarily directly and probably mathematically to some degree, but we can describe a lot of things, especially financial phenomena, in terms of basics of engineering, basics of semiconductor behavior, um, and even basics of like Newtonian mechanics. So, you know, while while those things don't directly apply, they sure as hell do tell a fun story and give a means of digesting these derivatives of base reality that we create. Like financials are a derivative of very fundamental things, and we have these frameworks and mathematical equations that help us understand them.
Yeah, it's interesting as I look at various DeFi protocols. A lot of times I'm reminded of, especially when I go through the process of sort of trying to diagram them myself or go through a greater depth of understanding. I find myself drawing parallels between drawing circuit diagrams and DeFi protocols. It's always kind of fascinating how these two spheres, seemingly unrelated, do kind of tend to gravitate towards a lot of the same, I guess, principles or strategies or approaches to problems in terms of energy conservation or be it sustainable tokenomics and things like that. So it's always kind of interesting to see how those overlap.
So most interestingly is voltage is current times resistance. And I have most recently been stating that that is a great way to understand capital flows, liquidity, and frictions from a financial perspective. And you that's probably one of the simplest mathematical ways to really describe a lot of the behaviors we see, not just in traditional finance, but the frictionless nature of crypto markets. We see that play out very clearly.
Yes, it is. It is quite interesting to see how that all happens. So I'm curious. What is your current assessment of the global financial markets? Global financial markets. I'll just ask the big question right off the bat here.
So everything in reality is moving in one direction or another. There is no state of constants. There's no steady state. And that reduces to concepts like entropy. Entropy is that's besides the point. But directionality, like someone is always gaining weight or losing weight. No one is ever the same weight tomorrow. Water fluctuation, so on and so forth. But everything is polar in reality: positive, negative, left, right, up, down, Republicans, Democrats, team A, team B. It's really just a knock-on effect of the basic fundamentals of reality in many regards, and humanity loves to express that in these derivative constructs that we create. So from a financial system perspective, we either have expansion or contraction. It's as simple as that. And right now we are directionally pointing towards contraction. And I've observed, and I'm sure a lot of folks from especially a traditional finance background have observed the reality uh, that is probably best described by the physical phenomena of resonance. We are having, over the past 15 years, successively exacerbated periods of expansion and contraction. And right now we're directionally pointed to a ferocious deflationary contraction at many levels.
And so I guess that kind of ties in as well with sort of following sort of a lot of your tweets and whatnot. The DXY chart. I was wondering if maybe you can speak to that because you look at it from a 6 month time frame frequently, And it sounds like that's where is that where you're drawing a lot of your conclusions from in terms of cyclicality?
Cyclicality, directionality. Now, obviously, things have a capacity to capitulate at any time, stop, reverse, and that tells us the story. Ultimately, there's ways to probabilistically express the likelihood of a directionality. And as of right now, from the DXY, which is a generalization, obviously, Japan and the ECB contributing most significantly to that chart, but that directionality is firmly down. Technically, from a candle pattern and the study of candlesticks in a chart form, a a giant shooting star occurred in H2, second half of 2022. And that is indicative of directionality reversal, capitulation. And we've had a couple of candles that support that directionality change. So from the 6 months, from the year is interesting, and you could go a lot more granularly to the monthly to see a little bit more of the short-term expectations. And when you do that, you see potential indications of that shooting star not playing out significantly to the downside. And you also got to factor in the reality that the DXY is a manifestation of geopolitical collusion at the central bank level. What is the Bank of Japan and the ECB doing? And that is ultimately what manifests a chart such as the DXY. It's not just an organic chart, and arguably it's not even an organic chart. It's a chart that manifests from geopolitical collusion. So from the 6 month chart, as of current, and at least the first half of 2023, it's directionally downward, which has a variety of meanings for global liquidity conditions.
So I guess for folks that are into DeFi and crypto, what conclusions can we sort of draw in terms of that directionality for stable coins and then also just for general governance tokens or what have you for speculation. I'm curious if you can give any insights to either of those areas.
Well, indeed, it's all related. So price points are a knock-on effect. Knock-on effects are obviously a causal relationship. If there's more liquidity, that liquidity, which basically means people in general have more free cash. Cash is another interesting conversation. And when there's free cash, when cash sits, cash gets not incomplacent. It wants to do something. It wants to engage. So that is how the knock-on effect plays out. When there's increased liquidity, there is a greater likelihood of appreciation of assets. And so that's why I think liquidity is the most significant thing. And generally, the DXY I like to think of as a broad way to view international liquidity conditions. China does play a significant role from a global M2 perspective, but generally Japan kind of finances a good part of world activity and has done so for decades at this point. So, but inevitably, even with the insanity going on from the Japanese central bank and a bond market level, I do want to believe there's going to be some sort of cyclicality from a global currency perspective. I think that would make sense. Now, I understand that the chart, as I said, is a manifestation of global collusion, and there may be some insanity at the Japanese central bank level. But the cyclicality wants me to think that the collusion efforts will force that flow to reverse. Now, the most notable thing from the DXY perspective is the duration of the cyclicality. We're talking like 15-year cycles historically. Now, this is the longest bull market for the dollar versus the ECB and the yen, ever, at least according to the post-1971 version of the dollar. So if we have cyclicality and global collusion efforts allow that depreciation of the dollar, we're in for, by definition, a super cycle of international liquidity conditions. Obviously, if they lose control at the Japanese level, their bond market, we could have big things break from a global FX perspective. So the net result, the net story that we see play out with regard to price action is a manifestation of all these pressures, growth and contraction, and the net is the story. So what I observe really is the tendency or the various pressures to increase liquidity or decrease liquidity, and they're all there. So there's incredible deflationary pressures all over the place, but there's also incredible data that suggests liquidity conditions can significantly improve for a long period of time.
Yeah, that's interesting. So the DXY has essentially gone through its largest bull market, as you said, 15 years. I'm curious, what other markets are you looking at, or charts or curves, or the indicators that would tell you sort of that are offering sort of confluence in terms of that directionality that you're talking about.
Well, ultimately, M2 obviously, but M2 is just slow from a data perspective. And that's also a knock-on effect primarily of relatively domestic credit markets. M2 is basically synthetic currency units, liabilities that are created by the commercial banking infrastructure around the world combined with the fractional reserve banking methodology. So M2 is meaningful, and M2 is up and to the right. It never dipped in 2022. So there is an availability of currency units significantly at the global level, and that was primarily a result of Japan, and especially China. Like, Japan compensated by itself for ECB and United States liquidity contraction. So overall, M2 from a U.S. and European level contracted, which would constrain and depress financial activity. Less currency units, less speculation, less credit, less everything. But Japan compensated entirely by itself for the ECB and the U.S. contraction. Now, China considered put it up and to the right. So there was an overall expansion of global currency supply, even considering what Europe and the United States did. So M2 is significant. What I like to look at is the move indicator, bond volatility, as Mike Howell so nicely talks about. And whether I noticed it first and then I found his content is irrelevant. I like the story that lower volatility conditions encourages activity. If price action is relatively stable, people are more likely to do things. If the market is crashing, people are more likely fearful. If the market is significantly appreciative, people are more likely euphoric and they're doing different behaviors. But if the market is complacent, and the bond market specifically, and this thought is complacent, and you have relative stability, which historically was supposed to be the case, the most liquid and stable market in the world, as U.S. Treasury and Yellen like to say, then the primary usefulness of U.S. bonds is the offshore printing of U.S. dollar liabilities. So when you see the move indicator down and to the right, that is indicative of a forward-looking indicator of increasing international liquidity conditions. And that's the same for the DXY. When the dollar becomes cheaper, foreign currencies acquire more purchasing power, which is relatively increased liquidity conditions. DXY down, move down is directionally indicative of increasing international liquidity conditions.
Yeah, just for our listeners who are don't have their charts up in front of them, I just pulled up the move chart on a sort of a 1 week time frame here, 1 week candles, and it looks like move spiked almost to 200, which is a fairly significant move back in March 13th actually, when we had the banking crisis here in the United States with the collapse of three major banks. And now it's sort of been flat, I guess, for the majority of the, or I guess it's moved down since then, but been mostly what looks to be kind of flat since kind of February since last year. But it's interesting with March. So I guess my question to you then, Captain Rational, would be, how do you like evaluate risk from a crypto DeFi perspective then?
So this comes back to maybe portfolio construction. There's always risk. So there's risk to not be exposed to a market, just like there's risk to be exposed to a market. You never want to not be exposed to a market. You always want to have assets, which is a contrarian thought, I guess, relative to the general population. General population is extraordinarily polar. I either have something or I don't. And they're very protective and fearful. And that is something to cure, something that has to be solved. And the ultimate appropriate approach to capital management is to both have and not have assets. And it gets more complicated as I've recently redefined cash to a degree. But ultimately, a portfolio has both investments and cash. So to account for the risk in markets, you adjust portfolio balance and position size, and maybe you spend less cash, which kind of makes sense. Whether you're spending cash on consumables, consumer staples, or you're spending cash to purchase investments, it's just a different type of purchase, but it's a purchase nonetheless. So exposure to crypto markets, I comfortably state that I don't see any investments that I find interesting from a traditional finance perspective. Now, I do have investments from a traditional finance perspective, but I'm not necessarily most interested in them. I have them because they make sense. It's a good choice, but they don't tickle my fancy. They're not, and that's important. It's important to choose investments that you think are going to contribute the most significantly to the portfolio as you define the type of construct you want to have. And obviously, everyone knows I want my construct to be a cash flow portfolio. And you can't do that from a traditional finance perspective. It's just not mathematically possible unless you have a certain net worth, which is probably at least millions, like $5 to $10 million. You could probably do some interesting things from a traditional finance perspective, especially with risk-free being 5%. But even so, the growth potential in the crypto markets is quite extraordinary. And then why would you expose to the volatility risk of the crypto markets? Because it's not a market of any country. And it's especially best thought of as an international market, and not just an international market relative to the United States, an international market relative to literally every single of the 195 countries on the planet. And Arthur Hayes defines it as outside money, and that's a great way to think of it. It's literally the 196th country in some regards.
Yeah, that's an excellent observation. I'm actually kind of glad you brought that up, as it looks like, from my perspective, that the crypto markets almost act more like an emerging market, like you said, like a euro dollar type system where a lot of the stable coins are collateralized by various crypto assets or liquid staking derivatives. I'm kind of curious to get your perspective on that as well.
Well, derivatives. As much as we could talk specifics about any of the thousands of assets or even assets that we have an interest in, ultimately it's a derivative. A derivative of what? And everything is a derivative of a fundamental unit of account. And then we could get obviously granular about the varying characteristics of our preferred stablecoins as we define them. But ultimately they are units of account. So derivatives have a place because the purpose of a unit of account first and foremost is accounting, not necessarily to be thought of as an investment. So we deploy two derivatives for purposes of investment and for other reasons. I don't necessarily nowadays consider a lot of derivatives as investments. I have a very specific definition for what an investment is, which is not necessarily what other people think. I don't consider Bitcoin an investment. I don't consider Ethereum an investment, for example, or even the LSDs. I don't consider them investments. I consider them, in many regards, a form of cash, which have their own conversation to be had, especially from a portfolio composition perspective. But that's the overall construct that I see. Investments generally are cash flow, things that produce cash flow, contribution to a portfolio. And I define cash as anything that could be liquid and sold for consumer staples or finance bills.
Yeah, and you really talk about it a lot with your streams, I think.
I try.
Yeah. Yeah, you definitely succeed, sir. And I'm really into getting please elaborate on that perspective, because I'm sure some of the listeners are not really following your stream, and I think it's quite different perspective on stuff than what we used to have, especially in DeFi. So maybe if you can expand a bit about it, it will be, I think, very useful for some of the listeners.
I'm happy to elaborate a bit. Yes, I obviously talk about this stuff to a great degree, but interestingly, every time you talk about these concepts, it becomes clearer and clearer. So let's give it a good shot. So the most important thing from a portfolio perspective is to define things. I remember years ago in my youth, and you hear investors talk about rules, define your rules, and a lot of folks used to think it's like prices and what do you sell when you buy it. Yeah, to the degree that those do consist a rule set to be defined, and this is a very intimidating thing, especially for new investors, to try and define rules. But what I'm talking about in the context right now is rules of a portfolio, which goes above and beyond.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
Rules of capital gains methodology and strategy. Maybe capital gains is a methodology that's a subset of the types of rules that I'm trying to currently elaborate on. So maybe capital gains are rules to increase the cash position, but I wouldn't consider capital gains strategy to be an investment. That would be part of the cash position of a portfolio or a methodology to increase the cash position of a portfolio. So my rules that I've defined over the years are generally investments are things that produce cash flow, and I expect them to continue to produce cash flow into the future. And that's how I size those positions. What is the likelihood that something will continue to produce cash flow into the future and speculatively increase the provided cash flow into the future? And that's how I size positions. Predominantly, I will size the greatest position to what I think is most likely to continue to exist into the future. And as and something that doesn't necessarily produce cash flow right now, but is speculated to significantly increase cash flow into the future, I'd probably size that relatively large. And then smaller ones are things that have an uncertain future. And I could probably describe these things literally in terms of how my portfolio is currently constructed. And in many regards, it's optimally constructed according to those rules. Now, cash is an interesting one because obviously I own Bitcoin, I own Ethereum, I have some other spot tokens, some fracks here and there. But I consider that cash. That's something that I would either invest or I would consume as required to pay my bills and go to the supermarket and buy egg sandwiches. I hope these rules help other folks make choices. Now, interestingly, in our Discord, my personal Discord, a lot of folks have other rules, and that's fine. And then the whole point that I would hope to express, especially to people trying to get into investing, is how do you define these rules? Listen to other people and how they've chosen rules, especially the big macro folks. And, they have the greatest of experience navigating these markets. And if you could extract their rules and come up with your own, then you're probably heading down the road of a well-constructed portfolio.
I appreciate that a lot, and I think it makes a lot of sense. I think that also this is not a subject that, at least in our circles, in the DeFi circles, this is not discussed that much. And I think your perspective on it is definitely both refreshing. I find it to be very mature. And honestly, it really is affecting the way I see things and invest with my own money. So I thank you for that. And by the way, it's also affecting at least one of the most talented devs that I know of. And I'm saying it like as a mental statement. Like, to me, no one is like this guy yet. And I can tell you that both of us are like, especially him, to be honest. Like, he watches everything. He sometimes asks questions online. It really is affecting not only our investment thesis, it also affects some of the tokenomics and we're talking about and stuff like that. So it's definitely quite a pressure to the whole DeFi discussion within things.
I appreciate that. I'm not the best with tokenomics, and obviously, like Matt from Tapioca and other folks, and like Michael from Curve, they have a different capacity than myself. So one of the most important things that any human, should realize is know your role, know what you're good at, and stick to it. So it turns out my role, my capacity, or my greatest specialty is seeing the relationship between things, and it really reduces to an astute observer of causality, and that's probably my greatest skill. I see the relationship between things. Like increased liquidity has an increased tendency for prices to appreciate. And obviously that requires me to understand tokenomics and monetary policy and things of that nature. I'm definitely not the best. I certainly wouldn't create the most superior tokenomics, but I definitely can sniff out what is a sustainable tokenomics model. And that's really where the concept or the observation of the Federation came into mind, because the first thing anyone's going to think of when they hear the word inflation and increasing currency supply, they're going to think that's unsustainable. And we all thought that in 2020. And we all saw the pool twos with the 1,000% APR, and it wasn't sustainable. But over the years, I started to observe, okay, what would it take for it to be sustainable? And what are the parallels we see in history? And one of the more interesting observations was the US dollar. The time frame that you needed to put the US dollar in to see it was probably about, 30 to 50 years. And post 71, we saw a significant increase in supply of currency units. So what was required, what was the mechanics for that increase in supply to be digested without causing some sort of currency event? It took a long time for the currency events to start to occur, especially in '08. And that was basically the 71 deal with Saudi Arabia that Nixon did, where they were a consumer. They were a consumer of excess supply, a sterilizer of the bond market of excess bonds in circulation, and the recycling of currency units back into the United States. And that's kind of where the puzzle pieces started from, is when I really recognized what occurred in 1971.
I definitely like the way this sheds new, some things, because I think that many of the people like myself, for example, what do we really know about macro? I mean, like the average crypto degen knows nothing about this stuff. You hear it, a while after a while, and it really is hard for many of us to comprehend. Like, I'm sure that some of the people, it's natural for them, and they're very much like getting it very easily. I'm sorry, I'm hearing myself when I talk, so it's kind of confusing.
The average degen, it is a hard story to try and tell to them. It's not price. Looking at price is going to destroy. And it's a tragedy. The vast majority of people lose money in investing. It has nothing to do with degeneracy in the crypto markets versus degeneracy in traditional finance. The only way to navigate, if you're navigating cross country and you have no terrain information, you're taking a significant risk. But if you have terrain information, you're going to be more prepared. Now, obviously, I learned a lot of this while traversing the terrain. But I guess as I mentioned, I'm an astute observer of causality. So I took probably more risk as I started traversing the terrain, especially in late 2019, 2020. But nowadays, I define a lot of my behavior as not risky. I actually am quite comfortable with. I would consider like risk. I have maybe one position that I would consider a risk position. That's about it. Everything else is significantly less risk as compared to that one position.
And when you say it's a risk position, you mean that it's like, according to your own reason here, of growth investing versus value investing? Because to my very basic knowledge, from listening to what you say here and what you say on the stream, to be honest, it's really kind of the dilemma between growth investing and value investing. And if I understand you correctly, you mainly say that, listen, growth investing is not really investing. If it's not generating a separate value to the investor, it's not really investing.
Well, growth and value historically was inspecting, value like a Buffett style investing is inspecting the balance sheet, and something isn't going to significantly asymmetrically appreciate as per the current growth narrative, but it's going to be a steady, embedded, entrenched piece of infrastructure in an economy and provide steady cash flow, growth of the cash flow of the company. But growth is kind of a different narrative. It's become perverted nowadays, where you expect significant growth of the stock price. Buffett talks a lot about buybacks and stuff, perverting these types of narratives. But But growth generally nowadays is probably best bucketed in like capital gains methodology versus cash flow methodology. Now, this one risk position I have, I would consider it a growth type of allocation. Every single other position I have is more of a value type of allocation. And growth is something I consider it a cash position. It happens to be an LP position, but if I bucket it according to cash, and if I need to sell it, I sell it as cash. But I do expect the quantity of that cash, the currency unit denominated, dollar denominated in this instance, in most instances, I expect that number to increase. So that's how I bucket this current position in my portfolio construct, and how I define it as well.
Yeah, that was kind of what I was referring to in my question, and thanks for clarifying that. Prophet Kmets, do you have some more macro stuff? Because honestly, I kind of want us to start talking about the federation rights and, Aladdin project relations and stuff like that. Of course, unless you guys have some other stuff in mind you want to discuss.
I'm good for you to go with that. So Prophet is.
So more than happy to speak to the Aladdin products. So, and I apologize, I must remain general. Generally speaking, it's a sterilizer and an excess circulating supply recycling regime, of which there's many. So there's a lot of peers. There's no clear way to distinguish between which peer is better or worse. They all have similar characteristics at the structural level. They all are permalocking governance assets, thus removing them from circulating supply in favor of accumulating the governance powers. And the governance powers are designed to direct the incentive regime of the base financier, which obviously is either the Curve Federation or the Balancer Federation at this point in time on Ethereum mainnet. And that's significant. Post-71 US dollar regime, anyone that was accumulating reserves, sterilizing US bond issuance, did very well. And they had reserves, they had protection when there was deflationary periods, they had value that accumulated and concentrated. And that's what's playing out here. It's like watching history doesn't repeat, but it rhymes. That's the causality that's playing out here as well. There's significant power that's being accumulated when permalocking occurs. And what's nice with these sterilizing products is that they have incentive regimes strapped on. So these incentive regimes of the third parties, Aladdin DAO and many others, are incentivizing capital to be deployed respectively, and that incentive is disrupting the base layer. So what happens is each one of the, you could call them satellites, consumers, recyclers, they become existentially related, and a synergy is evolving because it has evolved. This is the pattern, it's the causality. And, each consumer becomes existentially dependent on the producer, which is Curve in this instance, and the opposite as well. So the more sterilizers that come online, all the others benefit. I can't even list the laundry list. So they all benefit, and the base layer benefits as well. So it becomes that graph statement I made earlier. It's not just like a tree where the successive curve is dependent on the success of Aladdin and vice versa. But the successive curve is dependent on the success of Aladdin, is dependent on the success of Stake DAO, is dependent on the success of Convex. But it also goes to one another. The success of Convex supports the success of Aladdin, supports the success of Stake DAO, and this graph emerges where everyone is synergistically supporting one another, all vis-a-vis the producer's strength. It's quite fascinating the way those connections at least appear to me, but I think are actually the case because we have the history with what played out with the world holding U.S. bonds in reserve. So obviously we're in an interesting state where that has gotten to a perverted level, but that's clearly not the case what's going to play out with this currency issuer for many reasons. One, it's disinflationary. Deterministically, the curve emission schedule is disinflating over time, and it will run for over 100 years, to my understanding. I don't know the specifics off the top of my head, but that's not running out anytime soon. So that's quite interesting. It's not the subjective emission schedule of the United States currency, which is obviously based on human behavior, their governance processes at the Federal Reserve, as well as what occurs at Congress from a fiscal perspective. This emission schedule is 100% known, and it's 100% quantifiable. You literally know how much is going to be printed on a daily basis, where it is, who's accumulating what, and when that emission will decrease. That changes at least everything relative to the most recent historic sovereign comparison that is available.
Thanks for that. It was also something that I can probably listen to later and write some notes to myself as I listen to this.
It's a lot to digest, and certainly it's something to listen to a couple of times. But I think it's an interesting story that has become clearer and clearer the more times I've said it over the last year, especially. But I think I've had this story for about a year and a half, 2 years at this point. It was definitely becoming solidified, and because look, in 2022, things survived. Big things survived. Billions of dollars worth of capital was sticky. And that's extraordinary compared to 18 and 19. There was nothing. There was no market. There was no emerging market. And by definition, an emerging market, the success of a country in Africa is grossly or broadly describable in terms of how many dollars they could capture and create by offshore dollar printing mechanisms. So that's what's going on in the crypto markets.
True, and I think that it really supports your federation point, your general federation point, because I really think that, especially with, of course I'm biased because these are projects that I myself am interested in. Not talking just about Aladdin, I'm talking about, for example, shares, stocks, and all kinds of other stuff that, at least in some of them, I have some of my money. Yes, I really like. I will be kind of direct and honest here. To me, everyone is playing the curve game. You're not really. I don't understand what you're doing, and some of that I find to think
I'm losing you on the last couple of sentences.
What I'm basically saying is that when I view some of the protocols that I personally admire and find as
Sure.
useful, what I think they do best is play the curve game. Like if you're not playing the curve game, I'm not really understanding what you as a protocol is even doing, or as a DAO defense.
Well, interestingly,
And yeah, go.
interestingly, arguably, there's nothing significant to a protocol if they're not participating in an organized financial effort. So you have products, you have perp exchanges. But what is an exchange? Obviously, you have the gambling component to things, which is a business unto itself. Casinos are a big business. But how does that relate to something significant from a financial perspective? And that's really like an FX type of concept, and that's really from a currency type of perspective, which is a unit of account type of perspective. So Curve really ticks the boxes there. They have the critical stablecoin liquidity for a very obvious reason, but obviously Uniswap is part of this conversation, and Balancer is part of this conversation, which makes anything that's participating in that narrative part of this conversation, which is why Bunny came on the radar. And there's a variety, and there's a laundry list that are part of this overall Forex conversation and unit of account conversation and currency producers and consumers and sterilization. So it's a large federation. And that does diminish in many regards a lot of other protocols, a lot of other businesses, but that doesn't eliminate a lot of other businesses. This whole bot trading narrative is meaningful. There will be success there, and then hopefully cash flow as well. And this cash flow with the perp exchanges, GMX, and is quite successful. But bear in mind, it's how do I bucket stuff like GMX and stuff on Optimism? They're on microscopic emerging markets that have a fraction of the liquidity as compared to mainnet. So what do we know? We know that liquidity concentrates to where the most safety is, where the least risk is, where the most opportunity is. And that's exactly why in 2022, the vast majority of liquidity remained on Ethereum mainnet. What plays out the next time we have a global cyclical liquidity cycle where the liquidity flows will be quite interesting. It tells the story. But my expectation is the vast majority of liquidity flows to mainnet.
I think we've got.
Go ahead, Kmets. Go ahead.
Yeah, we've got about just a couple more minutes before we need to stop this space. But I want to give Crypto Prophet an opportunity to jump in and ask maybe our final question here. If he's got one lined up. So, Crypto Prophet, you want to take a crack at it?
Yeah, I'd love to. Hey, everybody. Hey, Noah. Thanks for your content, first off. I've been watching it, I think since 2021, and I think you're very spot on. And my question is actually, what you said about in 2018 and 2019, nothing really was sticky in liquidity is really true. And then if you look further back, it was even worse, even though in 2019 it was zero already,
Exactly.
So this is really a shift in the landscape, in my opinion, as well. And something I think you explain extremely well through all of your videos. But my question is I think in the future there will be a lot more crypto investors like you, but I think now you are very early on this income stream mindset, because it only makes sense if there is sticky liquidity, So it's the first season that it made sense, and you were really there for it, you could say. So how are you so early and so convicted? Although I do think this trend will continue. And then maybe to follow up with it is, what kind of variances do you expect between like your normalized income then, considering that you're holding these assets probably that generate revenue?
My conviction comes from the fact that stuff survived in 2022. It didn't just survive, thrived. And thrived doesn't mean it didn't depreciate. Thrived means it didn't, one, go to zero, two, there was tremendous cash flow, if not increasing cash flow, but at least sustained levels of activity and velocity. And there was capital expansion. There was plenty of offshore currency printing in the crypto markets in 2022. Plenty of capital was in DAI. That's literally a collateralized debt position. It's the definition of a euro dollar and offshore dollar printing. So I have convicted that there is an emerging market here that has been successful in capturing liquidity. And I understand that liquidity cycles. If 100% of the liquidity didn't flow out, it stayed for a reason. It stayed for something that people saw, opportunities that people saw. And that convinced not just me, but billions of dollars of other capital to remain, to participate. And there will be a liquidity cycle. Everything occurs in cycles over periods of time. Now, that period of time will vary 1, 2, 3, 5, 10 years. But inevitably, liquidity will flow in when that cycle starts to occur. And I want to be here for that cycle. So there's no leaving. That's not how capital management works. You don't exit. You navigate, you restructure. Depreciation is expected. So for me, I don't want to make the most money possible. What I want to do is survive and have a portfolio that is capable of surviving, continuing to produce cash flow into the future. And if it does that, and that alone, and I've seen that in 2022, and if we have a deflationary impulse in 23 or 24, and something survives, my conviction will only strengthen that during the next liquidity cycle, I will have had assets starting from Pico bottom that produce cash flow. And the liquidity into a market that survived extraordinary deflationary impulses, that is an outside market outside of any sovereign 100 of the 195 sovereign countries, the liquidity flow is going to be extraordinary. It should be a greater degree than what occurred in 2020, which is very speculative. We didn't have these clear macroeconomic structures in place and flows occurring. People will find the story that I'm telling now, and the story will be that much more evolved, that much more clear and obvious to many more actors, and that's going to be interesting, isn't it? Isn't it destined? Isn't it inevitable? Cycles are part of nature. The cycle will come. And mathematically, I'm guaranteed to be there because of my prevalence for immutability. There's no turning these things off. They will exist in 2025 and 2030, and I want to see what these markets will be like. So my conviction isn't necessarily even to make the most money. I want to be there when the cycle occurs. I'm so curious, and I speculate that they will do well.
Yeah. I totally agree to all of that, actually. I just sometimes think like if you had the same philosophy in like 2017 or 2018, it would have been like horrible, and like having it now is probably like generationally great. You know what I mean? So it's like being too early is super bad. But going onwards, sorry, if I can just finish this. I think what you are doing is actually like the evolved new way of saving for this generation, basically.
You could have done this decades ago in traditional finance, and you can do it in traditional finance with dividend stocks. What will survive? What is entrenched infrastructure? What provides critical services and resources and mining and has great dividends and cash flow? The problem is the scale that is required is significantly higher. and that's out of reach for almost everyone. You need millions. If you have, I mean, if you, literally just 5% returns on $10 million, that's a tremendous amount of quarterly cash flow just from government securities. And you overwhelmingly could live off of $500,000 a year in cash flow just off of, 2, 3, 4, whatever year bonds, or 4% on 10-year bonds, and you locked in $400,000 a year for the next 10 years. So, all right, come on, deflation. Deflation would mean that $400,000 a year is quite meaningful. But the problem is you need those 7-figure, 8-figure numbers to do these types of things. So you're forced to go out into the risk curve and speculate that an emerging market is doing the entire story that we've described, and that you're in early on cash flow that is meaningful and much lower price points, so you could achieve those the creation of this kind of portfolio structure without having to have $5-10 million.
Well, Captain, we really appreciate you jumping on today, and we want to be respectful of your time. We know that you got to jump, and we do as well. So, thank you again, sir, for hopping on and chit-chatting with us for an hour about all things crypto and DeFi. I hope we can do this again sometime in the near future. This was a great talk.
More than happy to talk anytime as time permits. Pop it on the calendar. Good to go. Much a pleasure today. It was a good one.
Amen. Thanks a lot for your time and for your kind of, as I said earlier, very refreshing perspective, which is kind of unique, in my opinion, at least with the folks I see and follow. And of course, thanks to everyone who listened, and to Prophet, and of course Kmets for another great job hosting as usual. Thanks a lot, sir. And
till next time,
you guys have fun. Amen.
Thanks, everybody. Bye.
Cheers, everyone. Bye, guys.
Thanks, everybody. Bye-bye.
This space was downloaded via spacesdown.com. Visit to download your spaces today. Download your spaces today.